What's going on, everybody? Welcome back to the ETF Tracker Show, brought to you by me, Cade, and Thomas Farr. And we're going to dive into all the things going on in the world of the macro, of the ETF world. An investor should carefully consider a fund's investment objective, risks, charges, and expenses before investing. A fund's prospectus and summary prospectus contain this and other information about REX shares. To obtain a fund's prospectus and summary prospectus, visit their website at rexshares.com. A fund's prospectus and summary prospectus should be read carefully before investing. We're super excited to be working with REX Shares, one of our longest running clients. Honestly, there's a bunch of stuff that happened this week, and you guys know me and Thomas are both big Bitcoiners as well. And so there's a lot of Bitcoin stuff and crypto things that just come out this week, but also just in general across the stock world, lots of generally interesting stuff going around. And so I'm kind of excited to jump into it. Actually, this is the one I want to pull up first, Thomas. It's good to have you, by the way. Early 2026 ETF leadership being driven by leverage. Top performers so far are XX crypto and a XX single stock semiconductor ETF. These are a few of the top. This is posted by Eric. He's senior analyst at Bloomberg. This guy actually puts out really good content. Really interesting stuff. A ton of return as well, 38% just in the first few days of January. I'm actually curious on some of your thoughts. I know in the first show of the year, which is honestly just a few days ago, now that I think about it, we had talked a little bit about our projections for where we think 2026 is going to head. But give me some of your thoughts. I mean, this is kind of cool. Like some top performing ETFs are in the crypto side of things.
Yeah, man. Well, I mean, as we talked about a few days ago, I'm bullish on this year, and that's kind of like, get the party rolling again. This is crypto and AI going again. So it's been a hot start to the year, and I mean, good on the degens that are getting in the 2x leverage, and they certainly crush it to start the year. But no, I mean, hot start, and we'll dig into it a little bit more. But I think it's interesting because a lot of people were positioned very bearish, particularly late last year, and I think you can already see this kind of a vibe shift. Like, it's going to be really interesting to see how quickly this if it plays out, right? If this keeps rolling a bit, because I think there's a lot of people sidelined. This might be one of those kind of hated rallies, and we've seen this before. I mean, 2024, massive hated crypto rally we saw where all these people were still sidelined from the previous, previous market, the previous cycle where they'd gone on, hopped off. They thought Bitcoin's going down, and then Bitcoin just ripped up. And Bitcoin is the perfect asset to talk about because it's so representative of liquidity, like macro in general. Bitcoin goes as the market goes, right? Or at least it has. I mean, it hasn't uncoupled as some people think it might. But so we're seeing risk on, AI up, Bitcoin up. Yeah, it's fun. It's good to see.
Yeah, no, 100%. And we talk about this all the time. Like, depending on where you are in the market, everyone's moving differently. In terms of the people building in these spaces, they're kind of just moving on business as normal. I saw State Street just put out that the ETFs in the United States saw 1.5 trillion in inflows into 2025. So, like, it seems to me at least that the markets are gearing up to continue investing. I know there are always like the people like the Robert Kiyosaki's, the Michael Burry's, who are calling for a full recession, a full crash. Which, I mean, yeah, at some point there's got to be, right. But like, you can only call that 1,000 times, and it just, because it's one of those things. Like, if you call for that type of thing, unless you bake in not a hedge, but like you have to sort of like build in your qualifications for that, and then also disqualifications for when you're like, okay, I've been wrong for 2.5 years straight, but I'm still not going to be wrong, so I'm technically not wrong. It's like, well, you've been wrong for 2 years straight.
2.5 years.
Yeah. So 20
years.
Yeah, 20 years. So I don't know. I don't know if you have any like knee-jerk reactions off this, but 1.5 trillion years, dude.
I mean, you're always going to have these bears that call 20 of the last 2 recessions and market crashes, and they get super famous in a way because it finally happens. but then they were, you got these guys that have been calling for a big bear market, like basically like there are certain characters, if you'd like, they've been calling for a bear market basically this whole millennia, like literally, like since 2000, and then it's coming, and then they got famous in a way because there was the crash, but then they called it again in 11 and 12, and over and over and over again, and then maybe there's something here in 20. Oh no, actually it's going to rip up. Like it's a classic archetype. And you can get famous doing it, and you can sell newsletter subscriptions and this sort of thing. And some of them, to be fair, I have a lot more respect for, the guys that put their money where their mouth is, right? So if you're calling your shot and then you're running short positions, I can respect that. But when it's, if it's guys just posting on Twitter or whatever, it's like, who cares? But yeah, I mean, 1.5 trillion ETF flows. It's a crazy huge number, but it's kind of, and we talked about this as well. It's part of this is just that this is like the power of the US economy behind it, right? Because so many of these flows are just passive. It's just people taking their incomes, taking a proportion of it and sticking it in. And so you have a structural dynamic where it's going to be positive flows. Like it will be, because income is being generated throughout the year in a certain segment of it. It's just savings. And it's going to continue, and then we'll see where it goes. I mean, I think the big dynamic is, it's going into the market, but the big dynamic is that this ETF revolution we're in, which has been going for a while now, but interestingly, it's just picking up steam, because for a long time these ETFs were seen as great vehicles because they're low cost. Like, these are just like a really low cost, diversified, passive investment tool. But recently, it's been the innovation in the ETF world is going, hey, what if we can use these products to enable people to access different positions that they never could before? Give people the opportunity to go short here or leverage long here, and it does create, so like more optionality, more availability for retail, and it puts the power in your hands, and you can really, screw it up if you don't know what you're doing, right? You jump in 3x long or 3x short in some vehicle, you won't understand. If you have to understand how much volatility is actually implied in this sort of thing. But nonetheless, it's like, I say, like, it's great because it's, democratize these tools and give people the chance to do what they want to do. And yeah, I mean, it's just exploding right now. So it's pretty cool.
Yeah, 100%. And, the first thing they pulled up, which was like the 2x long Dogecoin ETF, like, it's true. Like we talked about this in the market talk spaces, a lot of our traders, but they probably the last year or so, they've been calling it a trader's market. They're like, whether or not you're good or bad, it just is a trader's market. They're like, so those who can trade and truly can do it profitably have done really well, because, and then on top of that, all the products that have been made have been geared towards traders, whether or not they're good or bad. They're out there. My question that kind of popped up, creeped up while you were speaking. So, like, for example, if whoever puts out a 2x long Dogecoin ETF, for example, and then someone else pops up and posts the exact same one, is really the only, like, in that scenario where there's basically the exact same two things, is it really just a game of who's the most trustworthy or who's got the most liquidity? Or like, how does the battle even take place? Like, what are the things that people look for, you think?
Yeah, look, so I mean, there's a few factors, right? So one is going to be the tracking error that happens, because the products are going to be designed with the intention of, I'm going to do 2x the daily return of X product, like 2x Doge or whatever. And that theoretically should be, it can be quite naive to think, oh, that just means if we're talking about Doge, if Dogecoin goes down 5, I get plus 10, and if it goes down 5, I do minus 10, and if it goes up 5, I do plus 10. Yep. But the reality is, how do you actually create that dynamic? You need to be using leverage and all these things behind these sophisticated tools behind the scenes in order to generate that return, derivatives. And that requires execution and skill, and it doesn't always work according to plan. Sometimes you have these situations, I'm in a 2x vehicle, but Dogecoin went down 7 and my product went down 16. And 2 times 7 should be 14, not 6. What's going on there? So the problem is that you don't necessarily, the sticker might be 2x, but that's whenever you read these, the prospectus behind these products, what you'll find is that they strive to achieve these returns, but they can't guarantee it, because there is no magic way to just 2x. You have to use leverage and all these sophisticated tools behind it. And so you do your best to achieve it, but you can't always achieve it. And so then it comes down to execution. Like certain products actually do it better than others. And you can look at and the easiest way to do this is pick a 2x vehicle. Like a good example is MicroStrategy, because there's a ton of 2x vehicles out there that do 2x long or 2x short, and it's the same product, but some of them, when you look at the stretch over months, it's like, oh, one of them has done 20% worse than the other. Yeah. So it's an execution risk that you care about. Now, the other thing is that is a factor, but only a little bit of a factor. Some people care about this more than others, but it's the fees attached to it. Because what you will see is that they'll have different fees in terms of if you leave it in for a long period of time, typically an ETF might be, say, 30 basis points a year, but some of these more exotic products might be more like 100 basis points, like 1%. So you are going to care about fees somewhat, depending on and then it's like liquidity, like the buy-sell spread. In other words, and just for people watching this, like, what does liquidity mean? It means basically how easily can I buy or sell this thing without it moving the price. So something like, just take an example, you, me, like Cade, if we try and buy or sell Bitcoin, we're not going to move the Bitcoin price because it's a multi-trillion-dollar market. We can do our best. Unless you're actually Satoshi there, I don't think so. You are not going to move the price, but it's liquidity for who, and depending on what size. If Elon Musk decided he wanted to buy into Bitcoin at size, that might move the price
a little bit. Yeah,
it's like every liquidity is always relative. It's like liquidity for what size. Now, the point I bring that up is, if you're facing, if you're trying to use a really illiquid product, you don't want to be in a situation where you sell and then it ends up costing you multiple percent because you got slippage, where you sell and you can't find a buyer, so you have to take worse and worse prices in order to sell, or the opposite side, when you're trying to buy in and you keep bidding it up yourself. Yeah. And it's like, I was like, oh, this is great. I'm buying in and it's going up, so I must be doing something right. But no, you're just being the sucker at the table, paying more and more as you're buying in. So you want something that's more liquid, you can trade in and out of it without affecting the price of the vehicle. You want to have sort of trust that it's going to execute the strategy that you're actually trying to execute, and that means do 2x or 2x long, 2x short, and actually do it with a minimal tracking error. And you are going to care about the fees as well, and those are probably the big things you really look for.
Yeah, no, that makes sense. Honestly, we should probably in a future show get on some kind of ETF manager or someone to kind of dive into that as well, so we can dive deeper into that topic. I think it's really interesting. One of the things we had talked about, I believe we talked about this on a previous show. I'm going to pull this up here. It was, if you remember, we had gone through like one of the heat maps, I think it was, and we've gone through the various sectors. I don't remember if we hit on industrial specifically, or if that's one that you pointed out. I had just seen this post though from the ETF Tracker talking about some of the largest U.S. industrial ETFs by AUM. And there's XLI in here, VIS. There's a bunch of ones in here. I see the iShares and the Fidelities one, multiple iShares one, SPDR, of course. We've got FTXR. There's a bunch of ones that I recognize in this one. Obviously, the one on, I mean, there's some insane numbers for some of these. I mean, XLI with freaking 26.5 billion in AUM is nuts. Didn't know if anything comes to mind here. Also, and this is one we'll also hit on for like the Bitcoin side. There's some Bitcoin and crypto ones that we'll hit on in a few minutes here, but didn't know if there's anything that, if there's anything sticks out to you on some of these, but also like what, okay, well, we'll start with that then.
Yeah, for me, I think this is a story where people are looking for diversification. And this isn't the traders I'm talking about. It's long-term investors. And there is a narrative, which I think is a very fair narrative, a concern that when you look at historically, it's always been said, just buy, the best way to diversify your portfolio is buy the index, like buy, say, a VU ETF, Vanguard's S&P 500 ETF, and you're going to get a diversified stock portfolio. Today, though, we are in a moment in time which concentration in the Magnificent Seven, these top tech stocks, is like 37% of the index, just because of the market cap of these mammoth giant tech stocks. And so what you're seeing is you're not actually that diversified when you're buying into the traditional stock market. You're this traditional stock market has transformed over time to being a tech index, somewhat, a lot more than it used to be, or way more than it used to be. So now there's some people out there going, the old rule book has changed. If you want a diversified portfolio, you can't just simply buy the S&P 500 because you're going to be so heavily weighted tech. And that's where people are coming in and going, well, what if I get a diversified basket of industrials? And that's when you can get sort of people looking at these US industrial ETFs, XLI, and this sort of thing. So I do think that narrative is extremely interesting. And it's a challenge to the sort of traditional financial world, because you have these investors that are going, this time is different, which is always a kind of a dangerous idea that, the best way for me to diversify is now I have to be doing something different than what people said a long time ago, but for a long time. But the reality is that the world does change over time. So it's an interesting dynamic.
Yeah, 100%. I think you just hit that spot on. You actually hit on something that I was going to bring up in a tap here in a second, but I'll just pull it up now. Was the various different, and you hit on this earlier in the conversation as well, but the various different types of ETFs people can get involved in. Like you mentioned, there's a bunch that people can just buy in, sit, don't ever have to touch again. We've got the XX long Dogecoin ETFs for literally the entire opposite side, probably in the crew of the topic we hit on in the last conversation around people just throwing their money into anything that might make sense for tomorrow's 10x, 100x gains. We got a bunch of people just all across the board here participating in all sorts of different things. But, one of the ones here in QQQI, it's more of a high income for people looking for just, some type of monthly income as well. I'm sure you have to, add in a good amount of money in here. But these perform pretty well here. I mean, we're looking at 18.62% on a 1-year NAV return. And the next few down below, 15%, 9, QQQ, obviously 20%. But there's like all sorts of different ways you can start to see people putting their investments in. Have you noticed a trend, especially over the last few years versus in more recent years, with how people diversify, whether it's in the ETF world or more just single stocks, or if they're in crypto? Like, is there any like things you're picking up along those lines?
Well, there is, and this is, as you pointed out, the trend towards more demand for these income ETFs. And the reason why, you have to think about this. who wants these income ETFs? It's the boomers, right? It's people in retirement. So what's happening is that we were in a situation where the majority of the wealth in the world is still, well, the plurality of the wealth is held by the boomer generation. They hold more wealth than any other generation. And they're reaching an age, they're sort of aging out of the workforce.
Yeah.
And so these people that are high in assets but they still want to, they still need to live. So they're trying to generate income off their assets. They don't, and there are two different methods behind this, right? You don't have to be doing these kind of income type ETFs, because another option is you invest in a more of a capital based ETF and then you just sell down your capital. But people find the concept of selling down their capital stressful, because you're literally watching your capital diminish over time. And that's like, you get people, not everybody reacts differently, but people can get nervous about that concept, about thinking, am I going to have enough? I don't know, nobody knows how long they're going to live for. So you don't know how long your retirement's going to be. So you don't know, am I selling down too much capital, or am I not selling down enough capital? And it's this retirement income stream problem that everybody faces, because nobody knows how long they're going to live for. And if they're not working, they know they need an income, but they don't know. And it's a double-edged problem, because the boomers, they don't necessarily want to be consuming too little, because yes, you get benefit from giving money to your kids, but also, in the next life, you can't take your wealth with you, right?
That is true.
Once you die, it's gone. So you don't necessarily you want to be, if you've worked your whole life to build up this nest egg, you want to be consuming it to some extent, not necessarily all of it, but at the same time, you don't want to be doing too much. You definitely don't want to run out.
Yeah.
You definitely don't want to run out. And so these kind of vehicles that people can offer it's like a solution to this problem, where it goes, hey, invest in something that's still going to build capital of but we're going to generate some income. We're going to sell some call options, or there are different, we're going to generate a dividend stream, and each of these ETFs, people come up with these kind of bespoke strategies to generate that income. But that's the idea. Like, I will say, I don't think it makes sense for, like our generation to be investing in these income stream ETFs. Like, for me, it's just not a smart strategy, because we really should be in like maximum capital accumulation mode if you're under 40. But if you're over 60 and you're looking at retirement and you want more income, there is some logic to these products, to these vehicles. And yeah, we're in an aging population, which is the dynamic that the whole kind of Western world is in. Yeah, you're seeing increasing demand for these kind of tools, these kind of products, and that's what we're witnessing. So I do expect, this is going to grow, and especially because the other dynamic, that's really accelerated this is, historically, people use bonds for this kind of idea. Like, I can generate an income off some bonds, but those bonds have really gone out of fashion over the last couple of decades, partly because there was a long period of time when returns went to zilch. Like, you're getting no returns from bonds. Basically any time from 2010 to 2020, the yield is zero, and you just like, what am I even buying these for? It's nothing. And then even now, you're sort of going, okay, there is a bit of a higher return. Like, you can get, government bonds can offer you your 4% interest, which is something. But at the same time, people are worried, but is that going to all be eaten by inflation anyway? And what's the real return on that? Is that actually like the smartest way to go about it? So it's kind of a dynamic where bonds aren't as in vogue as they used to be. And so that, I think that's part of the story here as well. And that's why these kind of income ETFs started to become more popular.
Yeah, definitely. And plus, like with the rising interest in, well, at least in my opinion, maybe we're just sectored off in like Twitter land, where people have an exponentially more interest in like their personal finances and stuff. There's a lot of people, redirecting their efforts into whatever is going to get them. A lot of people are just profit maxes. They're looking for what's going to get them the most profit. We've also got the companies in here who are looking for the most volume, like whatever's got the attention, whatever the people want. They're going to try and make some of those products. We saw Morgan Stanley. This is in the last day or so. Big time player, just filing for a spot Bitcoin and Ethereum ETF. I believe they also filed for a Solana one. But we've had big players stepping in. But Morgan Stanley coming in for a spot Bitcoin Ethereum ETF. Just wanted your first, knee-jerk reactions. Was this something you expected to see? Were you impressed with this? Is this like, give me some of your thoughts on this?
Yeah, not something I expected to see for a couple of reasons. Just because Morgan Stanley is so late to the party particularly at Bitcoin, but like BlackRock has got this this was like a race to get dominance amongst the ETF world. And this race started 2 years ago, like literally actually almost 2 years to the day.
With IBIT.
And with IBIT, but also with Fidelity and, a lot of other, like those are the winners, right? But also Bitwise, ARK, Valkyrie, like there's a lot of people that have come in and tried to Invesco, a lot of people have tried to come in and generate assets for a spot Bitcoin ETF. BlackRock, as you can see there, 70 billion in assets has come in and actually kind of dominated sort of. It's not getting all of the flows, but clearly, if you look at the last 12 months, the vast majority of new flows coming into BlackRock spot Bitcoin ETF. Yeah, you can see that they've got 780,000 Bitcoin holdings, right? The Ethereum ETF, though, I do think there might be an opportunity to make it that an attractive investment, and the reason why is. Their filing is their Ethereum trust is going to be doing staking. And as far as I know, the other Ethereum trusts, the ones filed originally, were not doing staking, partly because they weren't allowed. Well, not partly. They literally, the rules were different. You weren't allowed to stake. Right. And just for people that are like, whoa, what the hell are you talking about with this staking? What that means in the Ethereum network and the Solana network and some of these crypto networks, you can think about staking as generating interest on your crypto. I mean, it's actually what it is. It's essentially it's using your stake in the network, what you own, to participate in the mining for new rewards. So you actually generate income, as in more crypto. And so,
but you have to sell, right, to gain any of that. To gain any of your profits, you have to sell that Ethereum at some point, right? So it's like so I remember Tom Lee talked about that, and he was like, "You're always staking," but I was like, "Yeah, but wouldn't you hinder the price of Ethereum a little bit also? Because if you're getting all this Ethereum, you're mining it a little bit, yes, but then in order to realize any of that profit, eventually you have to sell a lot of that Ethereum, right? Or unless you can just keep restaking it."
Well, yeah, you can keep. I mean, it depends what your Not necessarily, because you can say, I'm just trying to build my assets in Ethereum. Yes, if you want, ultimately, if you want the dollars, if you want your Ethereum to generate you dollars, then yes, you have to then like sell the staking. No question about that. But if you're just trying to build up your piece of the Ethereum network,
then this is a smart way to do it.
Yeah, well, I would say. I would even go a step further than that, and I would say it's a dumb way to do it, which is to invest in these products and not be staking. It's in other, like, I wouldn't. It would be functionally the equivalent of like holding a shit ton of cash, but keeping it in a vault and generating no interest on it.
Got it.
Right? You're costing yourself 4% a year if you don't generate that. And the problem is that other people are doing it, right? So if you don't do it, well, first of all, you're getting hit because there's inflation in your network. These networks are not like Bitcoin. Bitcoin, there's 21 million Bitcoin. It's set. It's done. Ethereum, Solana, these are inflating networks. The number of tokens is growing over time. And so in an inflationary world, you need to be inflating your own amount of tokens in order to at least hold ground, if not grow. And so it's frankly, it doesn't make any sense to invest in an ETF that isn't staking, because you're giving up 4% right there.
Right.
And that's like, that you can, another way of thinking about it is, it's like, imagine the fees of the product are 4%. Like, who is going to invest in a product where it's like, oh yeah, this is going to cost you 5% next year just to invest in it? Like, you're not going to do it. I mean, you'd have to believe it's the most unbelievable investment ever in order to take that thing. And then the fact that someone else can be like, well, hey, I can give you this exact same product, but you don't have to cop 5%. I was like, okay, well, I'm going to do that. I'm not going to do that.
Right.
So, and look, maybe some of the other ETFs have switched. I need to see what's happening on these current Ethereum ETFs, but I do know that historically they weren't staking. And I do think that it wouldn't surprise me if Morgan Stanley have kind of identified that as an opportunity. The other thing I would just say with this is that Morgan Stanley, that's sort of interesting as a market perspective, right, is Morgan Stanley, a financial advisor. They manage a lot of assets. They advise a lot of clients. If they start, like, is this a sign, you're creating a, and Morgan Stanley, like literally like 10,000 plus financial advisors. Like, it's a big institution. Are they going to start pushing their clients towards crypto? I think that's probably maybe the more interesting thing about this, because the vast, and we, by the way, dude, we get so lost on this on Twitter because, crypto is like everybody, when you're on X, it's like, it's not even cutting edge anymore. It's just like, it's normal stuff.
Yeah, that's true.
Go into the real world. The typical person, like, what's your Bitcoin allocation? Oh, it's 0.
Yep.
you meet 50 people, and 49 people have a 0 allocation. And then
does anyone in your world know that, like, your life on X at all, or do they have any clue?
Not really, to be honest.
Hilarious.
No. And that's quite, that is a funny dynamic, and we can talk about that at some point. But no, not really. And it's a different world. And so you have a situation where the vast majority of people are not invested in Bitcoin and crypto more broadly. And then you're going to have, taking people from 0 to 5%. And what does that mean for the asset going forward? And this is part of why, for me personally, I'm still extremely bullish on Bitcoin, because I still look at most people are not allocate. The time to be the time when the opportunity for Bitcoin is over is when is in a decade's time plus, when it's like everybody has got 10-20% of their investment portfolio invested in Bitcoin. It's just the most mature standard thing. That's when you go, okay, this asset has been monetized, and it might still do well going forward as the market does well, but it's not going to have this extraordinary adoption story behind it. But the reality is that the majority of the adoption is still in front of us when it comes to, say, Bitcoin, because only a tiny fraction of the world, and more importantly, a tiny fraction of the world's capital is actually invested in it. And so I do think that this is part of, like, when I see Morgan Stanley do this, I'm like, yeah, this is part of the adoption story. It's the TradFi capital finding its way to Bitcoin, and it just takes so much longer than you might expect, because it's like, oh, ETFs are enabled in the start of 2024. Everybody's going to rush to it. And then you've got this mammoth Morgan Stanley that comes along and is like, I'm going to wait a couple of years and then I'll, and that's actually the story, right? So you have all of these, endowment funds and just an enormous population of investors and lines of capital that are going, I'll just watch, I'll see how this develops. And over time, the capital comes, but it doesn't happen like on day one. So you just sort of get like hints of the story developing. And, we sort of talk about, look, Morgan Stanley's in it now. And this, but that's kind of how it happens, right? It's gradually.
Yeah, gradually. And then all of a sudden you've got, inflows of $660 billion from IBIT, 279 FBTC, 15 million for GBTC, 80 million for BITB, ARC with 43 million. And crazy numbers here in some of these flows all across the board. One other thing I thought that was interesting, we can come back to that if you want, was the Solana ETFs passing $1 billion in AUM. We have Bitwise with BSOL, $681 million. That actually shocks me. Grayscale with GSOL, 171, and the Fidelity coming up with $126 million. So a good amount of interest here strumming up for even some of the top altcoins here, which these numbers surprised me, but maybe it's because I haven't been keeping up with nearly as much as like a Solana. And I'm not sure, for the extent that people are watching, how much they're paying attention to like the altcoin ones. But I mean, not these are like just like some of the top ones. There's obviously a few more from Van Eck and 21 Shares, Franklin Templeton, a couple others here. But didn't know if you have any thoughts on these. These are a lot smaller, obviously, these four.
Yeah.
But still good numbers here.
Big numbers. And I think Solana, to me, Solana is the epitome of the staking story and understanding the importance of it. And the reason why is when you look at, and it can explain this quite simply. You go back to 2021, the peak price of Solana was about $270 a token. Today, it's trading at about $135 a token. So it looks like Solana is cut in half.
Yeah.
However, the market cap of Solana at its peak in 2021 and the market cap of Solana today are about equal. It's equal. Wow. And what's happened there is that the number of tokens in the system have doubled in 4 years. And that is inflation. But if you were someone that was really into Solana and you were invested and you were staking your Solana and you were growing your Solana stake you would have to be growing it by double-digit percentage every year in order to hold, like, to sort of stay, even just preserve your purchasing power. But you would have if you'd had this massive, if you'd essentially managed to double your stack over this time period. However, if you're somebody that the vast majority of people that were invested in Solana, they went on Coinbase, they bought some Solana tokens, they left them sitting in a wallet, whatever. You didn't stake it, you lost half your capital. And so that's why it's so important if you are going to invest in these ETFs, like, just make sure that you're investing in one that's staking, because otherwise I can pretty much guarantee you it's a bad idea.
But that's honestly crazy, dude. The inflation side of that. I mean, God. Yeah. Jeez, man, dude. That would be so rough, man. That would be so rough. I guess that's probably why there's interest in these various instruments where they provide a sort of an asymmetric upside or asymmetric like an arbitrage opportunity without them necessarily having to just go in and get like a big spot position of Solana. If they think there's going to be some outperformance in the next month or so, they can get in to a XX ETF. They can get into a XX ETF that's more in charge of a sector kind of thing and just ride those waves a little bit more, knowing that they're not going to sit there and make that mistake ever again. I mean, could you imagine, dude, just full clipping $100,000 into Solana and just watching it just go down purely because there's getting more out there? Oh, well, man.
And to your point, the adoption comes in waves, right? It's not linear. it's like no adoption, explosion of adoption, and then nothing. And so like if you're someone, like some people are like, hey, why would I want to even like, why do I want to worry about this? I just want to worry about like my profession and my family and my hobbies. And that's cool. But if you're someone that wants to, as you point out, if you're like, I want to ride the cycles, that's when you like some of these vehicles, they serve a purpose in that sense, and probably better, frankly, than say the traditional way of getting leverage, which is like you use one of these exchanges and then they liquidate you on a Saturday night, and there's like dodgy stuff going on there, so that's kind of the purpose of those vehicles.
Yeah, no, 100%. And that's honestly a lot of the main stories I wanted to get there. One other thing that came to mind was like something you were speaking about a little bit earlier, and it was in terms of diversification. So if you're someone who's like a big believer in gold or Bitcoin or whatever the asset is that you think is going to do well, do you think it makes more sense? And I guess this applies more so to hard assets because of the nature of this question. But if you're a big believer in gold, for example, and you want to diversify, does it make sense to get physical gold and then get into XYZ gold ETF? Does it make more sense to get physical gold and then an ETF that is more of the S&P or AI sector or something like that? Like, how do you think that diversification there like makes the most sense in terms of like true diversity, I guess? Like, I don't even know if it is diverse if you're getting gold and then also a gold ETF.
Yeah, because essentially it depends on why you want the asset, right? Because you might be an investor because you believe the price is going to go up, or you might be, historically, the investors in some of these hard assets are more, conspiratorial minded, or more not even necessarily wrong to be, but you're concerned about, is there paper trading happening where people are inflating the number of hard assets out there, but they're not really there. And then what are you really buying? I mean, go back and look. You don't have to go back that far. And by the way, I'm not suggesting these ETFs are like that, but just to paint the picture, if you're in 2021 and you were buying Bitcoin on FTX, you thought you were buying Bitcoin, but you were buying IOUs from Sam Bankman-Fried, and he didn't have the Bitcoin. Unless you actually hold it yourself, you don't. You what you're having is an IOU. Now, the thing about these ETFs is they're really trustworthy IOUs that everybody, not everybody, but like you have massive institutional backing behind it. So it's in some sense incomparable between some shady startup in the Bahamas and, like the might of the US financial system and the regulatory structures behind what these things offer. But the point is, it's like, how much do you trust what's there? If I buy a bar of gold, then I have the gold. If I buy a gold ETF, I'm promised it, but I'm relying on a counterparty. And and as long as we're in the world, everything is normal, it shouldn't be an issue. But you're still ultimately relying, like, hey, the gold is there. And by the way, people get worried about this stuff. I mean, you still see people say the US government supposedly has all this gold sitting in its Fort Knox vaults, but then is it really there? Are they auditing it? All this kind of stuff. These kind of hard assets, the problem, the tricky thing with them is, it's like, unless you have it, do you have it? That comes from, with a hard asset, it's like literally physically holding, or with a Bitcoin, you'd have to verify it, be it by running your own node or this sort of thing. But the problem is that there's a heck of a lot of responsibility and fear that comes with being responsible for the custodianship of an asset, because, like, hey, I don't want to get robbed. Nobody wants to get robbed. That's a real concern as well. Like, do you really want to be having bars of gold in your house? Like that sets you up for, someone showing up at your house with a hammer or worse and trying to, that's the idea of the wrench attack, which is people get seriously concerned about that. So these ETFs solve that custodian problem where it's like, hey, I'm not actually holding it. I own it and I get the upside appreciation of the price, but I don't have to worry about somebody trying to steal it from me. But then you have this like credit risk trade-off. So
no free lunches here.
No, you either take responsibility for holding it yourself, but then you better not lose it. You better not let it get stolen, all this sort of thing. Or you put trust in a counterparty, but you better hope they're not trading, selling you fake paper and not the real, you better hope what they've got there. You better hope that, Coinbase hasn't told 30 million people that, you all own one Bitcoin. It's there's a trust element there if you're relying on these custodians. And so, pick your poison or diversify, do a little bit of both. There's different ways. And it's so individual because it's like, how much responsibility do you want to take? How are you even capable? Like it would be, you might be like to grandma, hey, I think Bitcoin is a really good, would play a great role in your investment portfolio. But you might be like, grandma, I don't think you should hold your private keys because you might lose them. Or even personally, I mean, that's like, I love the idea of ETF, just like don't have to worry about losing private keys for Bitcoin or losing gold bars if that's your thing. So I do think that there's, it's a pick your poison type situation, and everybody's different individually.
Yeah, I would say that's honestly great advice. And like you were saying, there is no free lunch in this world. If you are pawning off the responsibility, they're going to charge some type of premium to take on that responsibility, as they should. But yeah, I mean, you do get that. You get to sleep a little bit peacefully at night. But although I have spoken to people who custody their own stuff, and they say they sleep better knowing that it's all theirs. Like some people are just like that. Like my dad likes driving a manual. I cannot tell you why. He just prefers to. He's like, I like that I can control it. I'm like, yeah, but they made the automatic for. He's like, I don't want it. And so it's one of those things that some people are just, they're built like that, but they also run risk. But I feel like on some level, if you are a big gold bug, I feel like it makes sense to hold at least a little bit of physical, to sort of just hedge yourself in terms of the safety side of things. If all your assets are IOUs, I don't know. I mean, if they're all IOUs, I get a little nervous there. Like if you got a lot of Bitcoin and none of it's custodied, like I feel like I'd be, I don't know. Like you want to have some of it, just even a portion in your own custody, at least in my opinion.
Sure. I mean, it comes down to what risks are you trying to, like one of the magical things about Bitcoin is that you can take it with you wherever you go. You can keep it in your head if you memorize a private key, and that, like, depending on your country situation, how much trust you have, like if you're, because bear in mind, you can't do that in a lot of in a traditional financial system. You're going to be locked into your government, and so it's a very different situation depending on your regime. And it's like, how likely is the government going to try and steal my money? Steal my, and that's like, well, do you live in, Venezuela, or do you live in a country with a government that you actually trust? Just using that as an example. But so everybody, it's like, depends on your situation. Likewise with gold, if you're holding it because you think, you're a prepper and you think war's going to break out, and then the only thing that's going to have any value in, when we're all in like a doomsday scenario is these gold coins, like, well, then you really don't want to be just stuck holding an ETF. But if you're just like trading this as a financial asset, then, the ETFs will serve you well.
Yeah, I think to each their own, 100%. Thomas, dude, this is a great episode. I think a lot of stuff to learn here, and especially for the folks who are whether or not you're a gold bug, if you're more into the stock world, if you're a Bitcoiner like us, these markets are all starting to merge together. People are, like we just showed you, Morgan Stanley, BlackRock, every Fidelity, every big player has entered the crypto world. They've already been in the traditional markets. The TradFi worlds have their eyes on crypto. The crypto people have their eyes on the ETF world and the stock world and the gold world. Like everyone's starting to blend together. And so I think these shows are great. Thomas, I think your perspective on the macro environment is super awesome. And I appreciate you, man. And for people who do want to find out more, you're also tracking those inflows and outflows on the Bitcoin side, and maybe more on other markets as well at some point on your X accounts. And so we'll have you tagged right above. But is there any final thoughts you have that you want to leave the audience with?
No, man. I mean, great chat. It's always fun to just keep track of the markets, and obviously it's important for investing ourselves as well. But really enjoying these chats, and looking forward to the next one.
Yeah, man, absolutely. And for people who are watching, definitely be sure to repost the stream if you enjoyed it, and follow ETF Tracker if you haven't already. We've got a lot of stuff coming at you, a lot of updates around these markets as often as we can, and we'll have another stream or show or space, something along those lines, coming out very soon if you're watching this today. And we'll see you guys all in the next one. Take care.